Most UK SMEs are sitting on cash that's quietly losing value. Inflation keeps eating away at purchasing power, bond yields barely cover the loss, and recent banking troubles have shown how quickly accounts can be frozen or access restricted. This stagnant Treasury situation poses a real risk to growth and financial stability. Real-world data shows something interesting. UK SMEs that put even a small amount into Bitcoin, just 1 or 2% of their reserves, have outperformed their peers who held only cash. Publicly listed firms like the Smarter Web Company and Panther Metals reported stronger market caps and healthier reserves after adopting a Bitcoin treasury policy. That shows that crypto can work as a diversification tool, not just speculation. Hello everyone and welcome to our webinar, Smart Crypto Allocation for UK SMEs, a practical strategies for treasuries growth. I'm Olavi and today I'll show you how UK SMEs can tackle these treasury challenges with smart, practical and regulated crypto strategies. Not hype, just building a stronger financial foundation. And also stay until the end and you'll get our complete toolkit with allocation frameworks, risk templates, compliance checklists, and a chance to book a free 30-minute consultation with our SME treasury experts. Crypto brings 3 big benefits for SME treasuries: diversification, hedging, and innovation. First, diversification. Bitcoin and Ethereum don't move in sync with stocks or bonds. Adding even a little can spread your risk and give your portfolio a boost. Second, hedging. Bitcoin is often called the digital gold. Unlike cash, it has a fixed supply, so it protects against inflation and currency drops. And because it trades 24/7, it gives you the flexibility when banks hit problems. And third, innovation. Crypto connects businesses to the new digital economy, things like DeFi and Web3. That means potential yield through staking, automated smart contracts, and faster treasury operations. It also shows the market that your business is. Forward thinking. Put together, these 3 make crypto a smart tool for managing risk, driving growth, and embracing the future of finance. Setting the right allocation. The most common question is, how much should we allocate? Research suggests a phased approach. Start with 1% and gradually increase up to 5% of reserves. That's the sweet spot. Enough to benefit from the upside without exposing yourself to excessive risk. Even at just 1 or 2%, SMEs have seen a stronger returns than those holding only cash and bonds. Let's walk through 3 examples. Example number 1, a small agency with £100,000 in the reserves. They allocate 2%, which is £2,000. They split it into 1,000 into Bitcoin, 600 into Ethereum, and 400 into pound-backed stablecoin. They use monthly dollar cost averaging, or DCA, to spread purchases out and cap any single asset at 1.5% of the total treasury to avoid concentration risk. This approach works well for micro businesses entering cautiously without complex governance. Example number 2, a growing consultancy with £500,000 in reserves. They allocate 3%, which is £15,000. They split it into 7,500 into Bitcoin, 4,500 into Ethereum, and 3,000 into stablecoins. Security is handled with multi-signature wallets, meaning more than one person has to approve the transactions. They rebalance quarterly with oversight from the board or investment committee to keep everything aligned. This approach fits businesses that are scaling up, want more structure, but still need the tight control. And example number 3, a mid-sized SaaS firm with £1 million in reserves. They allocate 5%, which is £50,000. They divide it into 25,000 into Bitcoin, 15,000 into Ethereum, and 10,000 into stablecoins. They run this with a formal investment committee and use different wallets for growth and liquidity. Monthly risk reports go to senior leadership so they can react quickly to volatility. This setup works best for firms with treasury teams that have the bandwidth for ongoing risk management. These cases show how SMEs can scale allocations responsibly, balancing governance with operational needs. Which brings me to structured allocation strategies. For businesses wanting a clearer roadmap, tiered strategies help. Always stress test for drawdowns and liquidity. Level 1, we got the conservative entry, which is 1% of the total reserves. Option A is to put it all into Bitcoin, stored securely in cold storage. This is about capital preservation and hedging inflation. For option B, we got to split it into half and half. Half goes into cold storage like Bitcoin and half remains liquid. This gives flexibility for SMEs testing Bitcoin in payments or keeping funds accessible. At level 2, we got strategic diversification, which is 3% of the reserves. Option A is to put 100% of Bitcoin for a focused store of value. And option B is 100% of Ethereum for yield via regulated staking. And option C is 50-50 between Bitcoin and Ethereum to balance growth with innovation exposure. At level 3, we got full diversification and yield optimization, 5% of the reserves. Option A is to put 100% into Bitcoin, a high conviction bet. Option B, 100% into Ethereum, maximizing exposure to DeFi and yield. And option C is 50-50 split, balancing growth and risk. Each level should be stress tested for scenarios like a 50% price drop or liquidity crunch to ensure business operations aren't at risk. Let's explore 4 important insights from diversification and portfolio performance data that support this. Even a modest allocation, around 4%, to alternative assets like Bitcoin or gold can meaningfully improve a balanced portfolio's annualized return and risk profile, demonstrating that small changes can have measurable impacts. Alternative assets help produce maximum drawdowns and volatility compared to traditional equity bond portfolios, providing vital downside protection during periods of market stress. The inclusion of Bitcoin or gold improves the Sharpe ratio, meaning portfolios become more efficient by increasing returns relative to risk without substantially adding volatility. Portfolios with small allocations to these alternatives remain highly correlated to their core assets, so businesses can diversify returns without drastically changing the overall portfolio behavior, appealing to conservative treasury management. Next, let's talk about selecting crypto assets and building the treasury. Not all crypto assets are equal. Let's break down the main categories. Bitcoin, the digital gold, strong hedge against inflation, highly liquid, widely accepted. The downsides are no built-in yield and high volatility. Yet big companies like MicroStrategy and Tesla keep buying, showing a long-term confidence. Next up, we got Ethereum, the backbone of Web3 and DeFi. Offers staking rewards so it can generate yield as well as growth. The downsides include higher tech risks and transaction costs that SMEs need to budget for. Next, we got the stable coins like pound, dollar, or euro backed. They're pegged to currencies. They're low volatility and great for operational needs like payroll or cross-border payments. They also act as a safe harbor during turbulence. The key here is issuer transparency and FCA compliance. Diversified products, ETFs, managed baskets. These spread exposure across assets, reducing concentration risk. The trade-off is paying management fees. A simple 3-bucket model works well. Number 1 in the bucket, we got the growth, Bitcoin and Ethereum. Second, we got core reserve, balanced assets for stability. And the third bucket, we got liquidity, stable coins for daily operations. So next, let's move on to UK SME case studies. The Smarter Web company. Since 2023, they've built up 2,470 Bitcoin, worth over $280 million through regular board-approved purchases. They treat Bitcoin as core capital, not speculation. They also disclose reserves publicly, report annually, and even accept Bitcoin payments. Their discipline and transparency show how SMEs can adopt crypto responsibly while boosting growth and resilience. Next, we got Panther Metals plc. In 2025, they allocated £5.4 million to Bitcoin. Their board approved it and disclosures were made through proper regulatory channels. This move helped hedge risks in the mining sector and positioned them as a leader among UK SMEs. Again, the key was transparency, governance, and regulatory engagement. Managing volatility and risk. Yes, crypto is volatile. Weekly moves of 10 to 20%, quarterly swings up to 60%, but risk can be managed. Cost averaging reduces timing risks. Regular rebalancing prevents overexposure. Caps on allocation keep things disciplined. Wallet tiers separate cold reserves from operational hot wallets. Custodians with audits, insurance, and segregation protect assets. Stress testing shows what happens if prices fall or liquidity tightens. Volatility becomes manageable when you plan for it. UK compliance and tax essentials. Regulation is tightening. By January 2026, the FCA will require stronger rules on stablecoins and custody. Crypto is usually classed as an intangible asset, so do get alignment with auditors. Corporation tax applies to gains. VAT requires pound valuation at transaction time. Payroll in crypto still goes through Pay, so keep the detailed records of every transaction in pound terms with custodian info, and always use FCA authorized custodians and providers. Compliance is about good governance. Work closely with accountants and legal teams. Conclusion, your path forward. We've seen how a disciplined, regulated approach to crypto can transform SME treasuries. Diversification, inflation hedging, and access to digital innovation. This isn't about speculation. It's about building a stronger foundation. Now you have two choices. One, do nothing and let inflation keep eating your reserves, or you can take control. Start with as little as 1% and grow at your own pace. To help, we're offering our exclusive toolkit, allocation frameworks, risk templates, compliance checklists. Plus, you can book a free 30-minute consultation with our SME Treasury experts to tailor a plan for your business. But spots are limited. We only have 10 consultation slots available, so don't wait. Secure your place now to future-proof your treasury and give your business the tools to thrive.